Stocks failed to build on Monday's gains as concerns over US Fed sticking to its tightening lines resurface ahead of Fed Chair Powell's speech today. IT and financials drag while metals and autos manage some gains.
TCS ekes out a good growth performance in the third quarter and exudes confidence in the deal pipeline. But a grim economic environment weighs the stock down and the IT pack as well.
Jaguar Land Rover posts a strong 15% growth in sales and a record order book, raising hopes of better margins and higher cash flows.
Sona BLW gains after it inks a deal to buy Serbian sensor and perception solutions player Novilic, while a nod for reimbursement of spends on a Eutonia drug by the National Health and Pharmacy Service in Spain boosts Lupin.
Signals of China looking to stimulate growth boost sentiment for metals even as global banks revise their GDP growth outlook.
Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Manglam Malu as well as Sonal Putra. Well, it's turning out to be a session where we're not managing to hold the momentum that we started the week with. So we have the Nifty, which is below 18,000 as we speak, and a lot of focus with regards to the macros. We have a whole host of inflation data which we have to reckon with this week. But more importantly, and possibly in the near term, is the US Fed chief's speech, which would be in focus in Stockholm today. So that would be something that we would be watching out for closely. A lot of stocks in focus, the data stocks such as TCS, Tata Motors, Sona, BLW, separately from the broader markets, Lupin, Syngene, which we will be discussing over the next 60-odd minutes. Hi.
Hi, good afternoon. The only thing that worries the street is the underperformance of the Nifty Bank, because on the way up, it was the Nifty Bank that led the index higher. In just the last three sessions, the Nifty Bank is down by almost 1,300 points in this, despite the up move that we saw in yesterday's trading session as well. And yesterday, we were supported by the IT pack, but today that's not supporting us as well. So as a result of which, we are lower below that 18,000 mark once again. But in the past, we have seen the market recover from that 17,850 to 17,900 sort of zones. So the question is whether we see another round of recovery or not. That's primarily because the way the mid-cap index is performing, we have the mid-cap index outperforming by not falling as much as the frontline indices. So let's see where we go. Hi.
Hey Manglam, hey Ekta. Yes, we are looking at broad-based declines across the sectors. The only two sectors which I'm looking at right now, which are in the green, is the Nifty Auto and Nifty Pharma. PSU Banking Index, which has been a big outperformer last year, is seeing some pressure today. And it is, of course, giving company to Nifty IT, Nifty Bank that Manglam just spoke about. So it's a very stock-specific action that we are looking at today. Individual pockets doing well, and news flow is something that is impacting some counters as well. But with that, we'll move on and talk about the first management on the show today. Delhi-based premium real estate developer has clocked sales worth 350 crore rupees for its recently launched luxury residential project. The project has a potential of 900 crore rupees with a saleable area of 5 lakh square feet. This is Stark that I'm talking about. The 2022 sales price appreciated by almost 25%. That's what the company says. To discuss the demand and business outlook, we are now joined by Amar Sareen, who's the MD and CEO at the company as well. Amar, good afternoon. Thank you so much for joining us. Well, I wanted to speak to you about this project where you executed sales worth 350 crore rupees. Can you tell us what is the timeline in terms of the rest of the project that is still to be sold? What kind of realizations are you looking at? Because I was just calculating, it is more than 1 lakh per square feet. So what kind of pricing are you seeing here?
Thank you for having me on the show. This is a project that we recently launched in October. It's a Delhi-centric project, very near to the airport. We have a total development area of 500,000 square feet over here, and we'll be clocking sales of between 900 to 1,000 crores from this project itself. Like I said, from October, we've already sold 40% of the project with 2 price increases. We launched at 15,000 rupees a square feet. We're already around the 20,000 number. And gradually going down this whole calendar year, which is looking very promising, we're looking at price increases as well as good sales velocity in all our projects, but this one particularly so.
Okay, well, Amar, hi, welcome to the show. I was just reading about the project. It is a gated community, 7D security, indoor heated pool, terrace area with an open air theatre, meditation deck. It almost sounds too tempting But, Amar, I just wanted to get an idea because you said around 40% is sold. So you have 60% remaining. You've taken 2 price hikes. You're at around 20,000 rupees per square foot currently. You have the potential to go higher. So tell us what the 60% would entail. When do we expect it to be completed? What is the likely sale rate that we could see and by when?
So on an average, we'll be around 22,000 for this project at a minimum. We're looking, like I said earlier, we're looking at selling everything over the next 12 months. The project we just started the construction 3 months ago. We're looking at completing it over the next 3 years. It's, like I said, it's one-of-a-kind project. We have the best amenities, the best specifications for all our customers over here. So yeah, I think it's going to be one of the finest projects in New Delhi. Like our other land bank, most of our projects are in New Delhi, with a few in Gurgaon. But this one being a Delhi-centered project, I think we have a lot of demand actually, from NRIs based in Dubai, Singapore, as well as the UK. Also, we're getting a lot of demand from HNIs in the city, and also, satellite towns around Delhi.
Right. Amar, I get your point that you are going to, sell the remainder in the next 12 months itself. You have strong demand coming in from all the players, etc. But just as far as your company's business is concerned, I just wanted to understand, you saw a rating downgrade on your NCDs recently. What led to this? Can you tell us what the outstanding debt on your books is, and what will it look like by the end of this year?
So we had Bain Capital, invest in our company to a total of 1,330 crores earlier in this year. This happens to be actually the largest transaction in the North Indian real estate market. They saw the potential in our assets. They saw the potential in our developments. They invested. The total, when they came in, basically this money was for taking over all our debt and also giving us money for growth. So this was growth capital as well as capital for our projects. The recent downgrade was, nothing else but old SEBI penalty, small SEBI penalty of 10 lakhs, which was implied on us from the year 2018. And the rating agency had an automatic formula for downgrading us. But having said that, we've already prepaid roughly 70 crores, which was supposed to be paid in the next year, which is 2023 September. We've already started prepaying all our NCDs, and we are looking to prepay much ahead of time. And this is all coming from, the robust sales.
Absolute debt, Amar. What is the absolute debt on your books right now, both long and short term?
So it'll be close to 1,150 to 1,200 crores of total.
Okay, so 1,150 to 1,200 crores is the debt, and any debt reduction plans, because you are anticipating some money to come in from the government as well. What are those receivables, and how much will the debt reduce by after that actually comes in?
So we are looking, as a company, we're looking to come to, a number of maybe 500 crores over the next 18 months on the total debt reduction. So, to look at roughly 700 crores of debt reduction over the next 18 months. And then our debt, which will be left to roughly 500, will be basically, just project-specific debt, which is all going to be paid from the sales and receivables from all our projects.
Okay. Just a quick two-part question. This voluntary prepayment of your NCDs, Amar, when do you expect to complete it by? 1. And 2, while Sonal mentioned that you do have receivables from the government, you have also indicated plans to monetize non-core assets. These two parts, if you could just, provide some perspective on it.
Of course. So as a company, we have 3 main avenues, for our sources of money coming in. One is the government receivables, which is totaling to roughly 500 crores, which is expected over the next 18 months at the most. Apart from that, we are also looking at land monetization. We just did a big land monetization where we sold our warehousing portfolio to Blackstone and another ESR logistic company called ESR. This was totaling to 400 crores, which we just completed in the last year. So we are also looking at similar land monetizations. And apart from this, the main focus which we are focusing on a residential portfolio right now. We're looking to launch 3 projects, which one is already launched. We just delivered a project with 800 apartments. And the total sale from these 3 projects itself is going to be roughly 5,500 crore, which are going to be launched in this calendar year, 2023.
So what does that do to your bookings target then? I mean, FY23 so far, if I look at it, you've done close to 400 already, with 350 crores coming in from this. First half was around 117 odd crores. You intend to monetize the remaining 60% as well in the next 12 months. What are your booking targets for FY24 and 25?
So for 24, we'll be doing between 1,500 to 2,000 crores for financial for 24, and at a minimum 2,500 crores the following year.
Okay, all right, Amar, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that is a north-focused real estate company talking about luxury sales, which have done quite well for the company. 350 odd crores is what they've clocked in already. It is the potential of 900 odd crores. They have debt of over 1,000 crores on their books on a consolidated basis, looking to prepay some NCDs as well. That's dark for you. Stock down around 2%. Time for a short break. But up next, we'll be discussing really what is one of the big stocks of the day, TCS. Reema will be joining in to focus on the numbers. The company released its.
Welcome back. Still tuned in to Halftime Report on CNBC-TV18. Well, the earnings season has kicked in and we have numbers coming in from TCS as well. That is something that they reported last evening. And, the stock is lower in trade today, down 2% because of a mild miss on margins. The stock has slipped after opening in the green. Reema is joining us to tell us why and what do the valuations really look like. Reema?
Thanks so much for that. So the numbers were not as bad as what the street was fearing. In fact, the revenues beat street expectations. There was a bit of a slip on margins as well as profitability compared to estimates, but again, not too bad. So the question is, why is the stock under pressure? One, there is still no clarity on what the future demand is. The outlook for next year, the year after, still continues to be fairly uncertain. Deal wins have moderated on a quarter-on-quarter basis. They're down 3.7%. The headcount has declined by 2,197 employees on a sequential basis. And this is only the third time in TCS's last 10 years that we've seen the headcount drop off. One of the reasons is attrition is coming down. The company hired aggressively in the first 9 months, hiring 42,000 freshers, and therefore they've got enough on their bench. But the other way to look at it is the company preparing for a slowdown. Also, the management is pointing to rising caution, particularly in Europe, where decision-making has slowed down, and Europe is about 15% of the company's revenues. Also, look at the deal wins, not just this quarter. In the first 9 months of FY23, the deal wins have gone up by only 3.5%. So there is a drop-off in the deal win growth improvement, because in FY22, the overall TCV or deal wins were up 10-odd%. The street estimates growth is going to slow down materially. This year, 13 to 14% was the street estimate for constant currency revenue growth. Next year, FY24, brokerages like Morgan Stanley, Kotak Institutional Equities is penciling in about a 7.5 to 8% growth. While margins have derated from peak levels, at the current juncture, TCS is trading at 25.5 times forward multiple, which is at a premium compared to its own historical valuation multiples. So that, on the other side, could be a bit of a concern that valuations are fair. But listen in to what the management had to say about the way forward and the outlook.
As we see it, there is a very strong pipeline. As I said, the qualified pipeline looks very good. In certain markets, the decision making has been a little slow. But we don't attach too much to the macro situation and the client situation, because we work very closely with customers across verticals, whether it's a broad-based order book that we have got, broad-based pipeline that we have got. So the kind of execution rigor that we have brought in, the kind of growth that we are seeing in the cloud and artificial intelligence and machine learning kind of work. So I think it all looks positive.
If you go to large enterprises in the big large markets like US, UK, Europe, which together constitutes somewhere in the range of 80%, 85% of our business. And as I said, again, we are talking of large enterprises. One way to look at it is that enterprise balance sheets have never been as strong as they are today compared to 5 years ago or 10 years ago. So balance sheet repair has happened. the easy money actually resulted in a fairly good disciplined execution on that side.
We came in at 23.4. We said we want to exit this year at 25. And structurally, we have worked towards it. If you see in both last quarter and this quarter, we have been able to get improvements. Two specific parts to it. One is we have been focused on execution rigor, and bulk of it is coming from the execution rigor, whether it was in terms of the churn which we went through the last year and the capacity building which we invested into last year, that coming into productive capacity and helping us on the utilization side, realization, the factors which we called out.
These 2 years have been a fairly strong growth years. The next year is like more a balanced year, a consolidation year, both on the revenue side as well as on the overall profitability side. The perspectives are very different depending on the markets. And I think the most important one is that we have a divergence in US between what the larger commentary is and what our own perspective is. And the 15% Europe, which has been a big growth driver for us till last year, that is off the boil and likely to remain soft in the near future.
All right, so that's about TCS. The stock lower in today's trading session, dragging the entire IT pack with it. But one stock which is actually outperforming the other peers is Cyient, as its subsidiary Cyient DLM has filed its papers for the IPO with the market regulator. Rima joins in with the details on that one. Rima, what does it mean for the company?
Thanks so much for that. So as you pointed out, Cyient's arm, that's the DLM business, design-led manufacturing, has filed for an IPO. It's filed the DRHP with SEBI. This is in line with the management's outlook to go ahead and list this business separately, unlock value. In fact, the subcommittee had also been formed a couple of months ago. Now, just before we get into the financials of DLM, what exactly is DLM? Now, Cyient does a lot of design for many of its clients. So, for instance, they have clients in aerospace, in the transportation vertical, railways, etc. Now, for instance, if they want to design a nose for an aircraft, right, the DLM business would also help them manufacture a prototype. So in that sense, Cyient, along with DLM, was not only designing it, but giving you a prototype by manufacturing it. So that was the, the synergy that Cyient was trying to derive from DLM business. But this was an acquired business. It was acquired by DLM in 2015 when they acquired Rangson's Electronics, but now they are looking to divest it. And because this is a manufacturing business, its margins are lower than the margins this IT services company like Cyient Services would enjoy. The details which have been shared on DLM, the IPO will have a fresh issue of 740 crores and the company will consider a further issue of equity up to 148 crores. About the financials of DLM's, this year the company was targeting a high single-digit revenue growth in DLM. Last year, the company's DLM business had revenues of $105 million with margins of 7.2%, about 15% of Cyient's overall revenues. This is incrementally positive for Cyient because one, it unlocks shareholder value, and it also helps the company to focus more on the DLM business and scale it up. Back to you.
Okay, all right, Rima, thank you so much for joining us with all those details. So those are some IT names which are in focus, but it's time for a break now. Sachitana Nutekar of Trade Bulls will join in with some trading strategies. On the other side, stay tuned.
Welcome back. We're meandering around that 17,950 odd mark, virtually closer to the lower end of today's trading session. We've been around that for the last half an hour or so. So let's get in some perspective on what's taking place in the F&O space this afternoon. So the market today actually has been led lower by two factors. One, the Nifty bank, which continues to underperform. So it's a big underperformer today. And secondly, there is no support coming in from IT. In fact, there is only pressure. So the Nifty is down about 0.8%, whereas the Nifty bank as well as the IT index, both of them down by about 1.2 odd percent. And while that has happened, there is risk which is back on the table. After a decline in the India VIX yesterday, we've seen that index spike by about 6 odd percent. And when the market falls and the India VIX rises, you see a lot of people, go ahead and cover their short puts. And that's exactly what happened. Yesterday, we saw calls running for cover, and today we are seeing puts running for cover. Yesterday, a lot of put writers at that 18,100 mark were active, primarily because the Nifty closed at that 18,100 mark. So they believe that there could be support around that 18,000. But the fact that we've fallen below that 18,000 mark, we've seen unwinding at that 18,100 put. And as that has happened, call writers have again tried to wrest control from the bulls, and they are writing the 18,000 call for a premium of 67 rupees. and they're writing the 18,100 call for a premium of 30 rupees, telling you that 1870 to 18,130 could prove to be resistance once again. And levels upwards of that, of course, we have the technical resistance coming in for both the Nifty as well as the Nifty Bank. 20-day moving average around that 18,200 for the Nifty. For the Nifty Bank, it is 42,700. Can things change? Well, the only way they can change is if HDFC Twins as well as ICICI Bank, along with Bajaj Twins, if they do something post 3 p.m. Why do I say post 3 p.m.? Because it is Tuesday, weekly options expiry for the Nifty Financial Services Index is at 18,500. Let's see where that goes.
Okay, all right, Mangalam, thanks very much for that. So yes, maybe cues from the financials is what we look out for in the second half. As of now, we have the Bank Nifty, which is down around 1% and the Nifty PSU Bank Index, which has been a rank outperformer last year, is seeing pressure today. So down around 2.6% currently for the PSU banking space as well. Sachitanand Utterkar of Trade Bulls joins in on the show to discuss his technicals. Sachitanand, hi, welcome to the show. Well, let's start with the entire financial space. You know, we've been discussing that a lot of stocks are on the decline, especially even from the PSU space. What would you strategize and what are your recommendations this afternoon?
Good afternoon. I think the pressure continues on the Bank Nifty, and if you look at the sequence, in the way its constituents have been performing, we saw ICICI Bank and HDFC Bank leading from the front, and today I think the major contribution has been from SBI. So even last week we were discussing about the hurdle at around 620 on SBI and how that particular hurdle may act as a resistance. And post that, we have seen a fresh breakdown in this particular counter, which has led to the fall in Bank Nifty as well. So the setup continues to be a good sell-on rise. We are still not seeing any, data flow wherein it is recommending a change in stance. So as of now, if you look at the way Nifty Bank has been performing, especially on the indicator front, we have a confirmation from the ADX, which has given a breakout about 26. Now, this is a good indication of a directional momentum play. So far we have not seen any signs of cool off, and probably we may see Nifty Bank drifting towards its 20-week exponential moving average, which is placed around 41,300. So we continue to deploy shorts. So we are recommending fresh short positions even at this juncture. The stop loss should be placed at around 42,560 on a closing basis from here on. Now, this is a significant level if you look at the way its 5-week exponential moving average is placed. So unless we don't see a closing above this, we are expecting that this particular underperformance in Nifty Bank should continue. So clearly, it's a sell-on rise market. And when it comes to Bank Nifty, the stop loss should be placed at 42,560. And a positional trade or a target is placed somewhere close to 41,300.
Sachidanand, quickly, can you tell us what are your stock recommendations in that case?
Well, Sonal, I think SBI is a preferred short candidate. We have already seen a good strong OI addition of 3%, a bearish crossover on its short-term averages, and the 600 support has already been breached. So still we expect this particular momentum to continue towards 575 on a positional basis. The stop loss should be placed at 605. And the second counter which has been on a radar is Maruti. Despite of the move in autos, this particular stock has been underperforming. There's a clear-cut resistance near its 200-day exponential moving average, which is placed at around 85.30. So unless we don't see a closing above that, we may not see the change in trend. So expect Maruti to drift towards 81.80. The stop loss should be placed at 8440.
All right, Sachi, thanks a lot for joining in and giving us your views on the individual stocks as well as the index itself. Before we step into a short break, just pull up Lotus Chocolate. The reason why we discussed this is because just towards the end of the previous year, which was on the 30th of December, Reliance announced an investment in Lotus Chocolate, and ever since the stock has only hit upper circuits. In fact, in the few sessions that we've had in January itself, the stock is up around 41%. So just watch out for that one. 172 on the stock. The open offer that Reliance had made for additional 26% of the company was close to around 117 odd rupees. So that is Lotus Chocolate up to around 172. Most of the gains coming by in just the last few days. Consistent upper circuits is what the company has been hitting. Take a short break. Come back. On the other side, we put focus on stocks that are buzzing in trade on the back of news updates and brokerage notes.
Welcome back. Still subdued for the markets at this point in time. We have a couple of stocks which are managing to hold their head above the water. Apollo Hospitals, Divi's Labs doing well from the pharmaceutical/healthcare space. But just talking about that, one important trend to probably track over the next couple of weeks and maybe months would be the fact that mainland China has reopened its borders. And one of the key trends which seems to be re-emerging is vaccine tourism. So a lot of people are actually leaving China, citizens of China are booking vaccination appointments for other COVID-19 vaccines. Remember that they have only Sinovac as well as Sinopharm, which is available in China. So now they want to access the mRNA vaccines, the other vaccines which are available globally, and hence there's a surge of vaccine tourism which is taking place. Right now, it's limited to probably Hong Kong and a couple of other countries close by, such as Thailand. But there's a hope that it could probably spread to other places in Asia, in the US, as well as in Europe. So that would probably be just something anecdotally to look at. But Tata Motors is the top gainer on the Nifty this afternoon. This is on the back of very strong JLR wholesale numbers. Sonia's here to tell us more. Sonia.
Well, thanks a lot for that. JLR wholesale numbers are looking very good for this quarter. So Tata Motors gives a quarterly update. And if you look at it, it's a 15% growth year on year that JLR has seen in their numbers, while even on a quarter basis, there's a growth of almost 6%. Now, the management has said that the key reason for this improvement in JLR numbers is that the supply challenges have eased and production has gone up. Hence, they're able to service the demand. They have a record order book of over 215,000 units, and a lot of brokerages have given a thumbs up to these numbers. So if you look at it, CLSA has upgraded the stock to a buy with a target price of 512. They say that now Tata Motors will be able to achieve their free cash flow positive motive by end of FY24. Then improvement in volumes and margin profile will aid the free cash flow generation. And Morgan Stanley says that JLR will generate 400 million pounds of positive free cash flow. Now, if you look at the graph coming up on your screen, the wholesale trend has been improving for the last few quarters. It's been volatile, but on an improving trend. And now in Q3, 79,591 units is the best that we've seen in the last many quarters. Hence, the stock is looking pretty good in trade. But it's still a distance away from its 52-week high. Back to you. Okay, Sonia, thank you so much for those details. A big move on Tata Motors is what we are seeing today. In fact, let's continue with the auto theme. Nimesh, in his standout brokerage report earlier today, highlighted a note from BofA Securities on the auto space. Let's revisit that. Nimesh, tell us more.
Today, the standard report was on autos, and BofA Securities has today upgraded the two stocks in that pack. So they've upgraded Tata Motors and TVS Motors. For Tata Motors, the new target price is 460 for BofA, and for TVS Motors, they've raised the target price to 1250. On top of that, the preferred bets in the auto pack are Maruti and Ashok Leyland. Now, the key themes and the reasons why they're bullish on autos. One, they believe that the valuations are at near mean or below that, and there is an earnings upgrade as well, which is possible. So that's the big headline on which they're bullish on. In terms of themes, they're playing on three specific themes. One, the first theme is the good model cycle, and in that, Maruti fits in. The new SUV launches and regulations will mean that there are further upside to the volume growth for Maruti, and hence they are bullish on Maruti. The second theme is the laggards that are delivering well, and in that theme, Ashok Leyland fits in. So they believe that the CV cycle and the fact that they're gaining market share is surprising positively, and that's why they're bullish on Ashok Leyland as well. And the third theme is credible offers in the EV space, and that's when they've upgraded both Tata Motors and TVS Motors. And remember, both the stocks have corrected off late, so there is a risk reward which is favoring them. As far as Tata Motors is concerned, they believe that at these valuations, the market is not giving just zero valuation to the JLR, and that is bearish, and hence they've upgraded Tata Motors. Within the pack, the only underweight, or maybe they've downgraded Hero MotoCorp to neutral, and the only underweight is Escorts. But today, they've upgraded both TVS Motors and Tata Motors to buy, and they've raised the target price as well there.
All right, Nimesh, thanks a lot for that. With that, we'll step to a short break. On the other side, we will focus on stocks like Lupin, Syngene, Reliance that have some news.
Welcome back. Well, the pressure on markets continues. Look at Nifty Bank. It's down 630 points right now. So the selling pressure has in fact intensified at the day's low. And a couple of these stocks, we have the likes of SBI, which is at the day's low. We also have other stocks like HDFC Bank. All of them are putting pressure on the Nifty Bank right now. So that is something we'll be tracking as well. But in the broader markets, we have Lupin, which is higher in trade today in a weak market. Ekta, what's the news here?
Well, for Lupin, you know, the news is that they've received the approval from the Spanish government for reimbursement of one of their drugs called Namuscula. Now, basically, this particular drug is used for the symptomatic treatment of this particular condition called myotonia, which is a neuromuscular disorder. Now, they will be commercializing this product in Spain with their partner. What this means is that they are approved for insurance reimbursements in Spain, and hence the possible traction for this drug would increase because the patient would benefit from an insurance reimbursement. In any case, this is a very rare disease, and it is expected to not have too many drugs which manage to treat it, and hence it could possibly be a positive for Lupin going forward. The stock, remember, is higher by around 1%. They're also showcasing at the JP Morgan healthcare conference in New York. So maybe that would be an added sentiment boost for Lupin. But separately, I'm also tracking Syngene, which is in focus on account of Axis Capital, which is written on Syngene. They've upgraded the stock to add with a target price of 670. According to them, the company is well placed to capture the industry tailwinds. They are well positioned to monetize on significant CRO as well as CDMO opportunities, which is basically contract research as well as contract development and manufacturing. There is readiness via ongoing capex. There is expansion and extension of dedicated client contracts as well, and a scale up of the biologics manufacturing. Lastly, they are going to be commercializing their Mangaluru plant, and there will be a supply to Zoetis, which is basically the animal health company, which will take place Q3 FY23 or FY24 onwards, and hence that would be a kicker for Syngene. Remember, Syngene is a part of Biocon. It is the CRO CDMO arm of Biocon. But you're tracking Safari, Mangalam?
Yes, I am. And that's because a lot of people are traveling, and for traveling, you need a lot of luggage. And for people to supply more luggage, they have increased their capacity. That's the sum and substance of why Safari is buzzing in trade today. They've, in fact, gone ahead and, actually, before we talk about Safari, just keep an eye out on the Nifty, because there's been a big decline as we speak. 200 points on the Nifty. In fact, just moments ago, we were looking at 17,950 on the index, but now it's gone to 17,900. The Nifty bank is down 650 odd points. But if you just take a look at a bunch of stocks which are declining from the front line, and we do have, Reliance, which was already under pressure, has now moved to the low point of trade. The Nifty IT index also has moved, has managed to put in some bit of fight, has recovered a tad, but again is at the low point, in the red. So that's not helping the cause too much. It is the Nifty bank which continues to put further pressure on the market. 17,900 on the Nifty. Same time last week, we were looking at these levels for some sort of support. Let's see whether it comes by or not. 17,860 is where the 100-day moving average of the Nifty is placed right now. As the market has fallen, we also see the India VIX rising. So the India VIX too has spiked to the high point of trade. And all the Adani Group stocks, actually just pull up all the Adani Group stocks and the intraday chart of that, and you'll see accelerated selling out there. Adani Enterprises and Adani Ports, of course, from the frontline end, not doing particularly well. And then we have a bunch of other names like, Adani Wilmar, which is at the low point, Adani Green, Adani Total Gas, Adani Power. The entire Adani Group is currently at the low point of trade. So there has been accelerated sell-off now. It is down 200 points for the Nifty, 630 points for the Nifty bank itself.
Okay, well, we'll wait by for the European market opening because that's expected to trend lower. And obviously, the big cue would be from the Fed speech, which will take place. So those are the cues that we will be waiting by for at this point in time. We do have an advanced decline ratio, which is trending on the weaker side, around 1,388 stocks advancing to around over 2,000 stocks declining on the Bombay Stock Exchange, and a similar kind of ratio that you can see on the National Stock Exchange as well. It is the banks, the financials, which are really leading this leg of a decline. So the Bank Nifty at the low point of the day, down around 1.5%. We'll do one thing, take a break, but on the other side, Manisha Gupta, commodities editor, will be joining in with Colin Shah, MD of Kama.
Welcome back, and joining us now on the show is Colin Shah. He's MD at Kama Jewelry. Colin, hi, good to have you. And an 8-month highs in case of gold prices. I'll talk about prices to you, but IIJS is one of the events that India jewelry bullion sector watches to understand what the trends are in the industry in sense of buying. We do understand that the footfall or the attendance was as high as it always is, but the buying was perhaps slightly dented this time around because of the running gold prices.
True, Manisha. So, IHS signature, like you correctly said, is a barometer for how the year is going to be. But the dampener for us was the extremely high gold prices. They've gone up unprecedented and have been climbing up. So, on the plain gold side, IHS was a little subdued compared to how it used to be in the past. But on the diamond jewelry side, it was positive. But all in all, retailers are in a watch and wait kind of mood. I think as the next couple of weeks go by and the wedding season gets a little stronger and the rate stabilizes, what we've seen is at every level, at the 50,000 level, it took some time for the rate to stabilize. At 40,000, it took in the good old days. So at this new rate, once it stabilizes and the consumer knows that it's not going to go down, that's when buying will start. So we are cautiously optimistic and budget is around the corner. So let's wait and watch.
Cautiously optimistic is a great word there. But also talk to us about on how the last 1 month has been for jewelry as an industry. Has it been a slowdown? Is it bothering, concerning you?
There has been a slowdown, and December, contrary to expectation, I would say, because that's like the main Christmas season month, was very soft, and even exports were down. Domestic business also has been a challenge. The high gold rates, Russia-Ukraine war, all the various news, inflation in US has not been so kind, I would say, to our industry. So we have had a soft December and even a soft, I would say, start to the new year. The frequent lockdowns in China are also, I would say, really affecting the pricing of larger diamonds. And the Chinese New Year is around the corner now. They've taken a little tolerant, I would say, outlook towards COVID. So if China opens up, that could be what the industry really needs at this point.
When you look at gold vis-a-vis the other asset classes, this clearly has been a good performance that gold has put out. So while international equity markets in the red, Indian equity markets in the negative, gold is trading 3% on the higher side. Are you looking at that leading to some buying, or do you think the investors actually have moved on to gold as a financial asset class and not so much jewelry?
I think, like you correctly said, they have moved on, as a financial asset class. And on the jewelry consumption side, the consumer globally in India and in China is waiting for some kind of correction. So at 1871, gold is high. It still looks like it's going to, reach a higher level before there is a slight correction according to the technical charts. And once that correction happens, we'll see a larger consumption of gold on the jewelry side. So that's definitely the expectation right now.
Colin, also, when you look at the Indian markets, and these are various reports suggesting that the spot market, the cash market, that is, the Indian gold prices are trading at nearly $30 off a discount. Is that any help, solace at all, or is it an indication that there are no buyers and thus the discount?
There are no buyers and hence the discount. And another big concern is that at these very high gold rates and the duty structure that we have in India, duty plus GST, the grey market, coming through other channels has really gone up. And we're really hopeful that this budget, the government will reduce the duties on gold, because this mismatch, it's taken great effort from the gold control days and demon and, everything, GST that we've gone through to make the trade organized. So while, the trade has really become organized and the organized players are growing in leaps and bounds, this high duty structure is creating this mismatch. And it will continue to be this way unless our duties are rationalized.
Well, absolutely. Budget is going to be one important area to watch out for jewelry sector. One last question, Colin, and I was talking to somebody in Dubai and they said the buying here is quite nice with the 18% of a duty difference between India and Dubai. Dubai really seems to be a place to go to. Do you think that is another thing that the Indian government will perhaps watch out for this budget?
They should, and it's not only, I would say, of course, Dubai being only 2.5 hours from India, so anybody who has, wants to buy 10 lakhs of jewelry, the flight ticket, even with the increased travel fares, comes out of just the duty differential. So having said that, Dubai's gain is India's loss. But most importantly is that and what we've seen over the last several years, the government feels that due to the CAD deficit, by increasing the duty on gold, somehow the imports will come down or the appetite for gold in India will come down. But sadly, that hasn't happened. And gold consumption has stayed at 600, 700, 800 tons over the last 5 to 10 years. And the duty increases is only costing the consumer more and creating the mismatch between the gray market gold and the official gold. So we're really hoping that duties are rationalized to some extent, and we look at sovereign bonds or the gold monetization scheme or other things to get, the grandfather's gold that we have in the country so that the imports come down. Just increasing duty is not going to reduce the imports of gold.
Absolutely.
Okay, all right, Mr. Shah. Manisha, thank you so much for joining us and taking us through that discussion. So while gold is seeing some gains, it's our markets which is under a lot of pressure. Nifty at the day's low, cut off around 210 points, and Bank Nifty is the one which is putting so much pressure that we are seeing across the major indices as well. Slip into a short break. We'll come back. Business Lunch will take all the action ahead.